Hello and welcome back to the channel, where we break down the most intriguing setups in the market. Today, we're diving deep into a fascinating microcap biotechnology company that's caught our attention due to its incredibly high cost to borrow, VRAX Biolabs Group Limited, trading under the ticker VRAX. We're going to explore why this stock is becoming so expensive to short, what that could mean, and what factors traders need to keep an eye on. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/stock chart. Let's start with a quick overview of VRAX Biolabs Group Limited, or VRAX. This company operates in the healthcare and biotechnology sector with a current market capitalization of about $3 million. VRAX focuses on immune response detection, T-cell immune profiling, and developing in vitro diagnostic technologies for various viral and immune-mediated diseases across the United Kingdom, the United States, and China. Their offering, VRAX Immune, is a T-cell immune profiling platform. Now, looking at the recent price action for VRAX today, the stock is down 8.11%, but over the last 5 trading days, it has seen a bounce of 17.61%. However, zooming out a bit, VRAX is down 16.42% over the last 30 days. What is cost to borrow and why it matters? Geographic cost to borrow explained. So, what exactly is cost to borrow, often abbreviated as CTB, and why does it matter? When you short a stock, you're essentially borrowing shares from a broker, selling them, and hoping to buy them back later at a lower price to return to the lender. The cost to borrow is the annualized fee your broker charges you for borrowing those shares. Think of it like interest on a loan. When this fee gets extremely high, well over 100% annually, as we're seeing with VRAX, it tells us there's intense demand from short sellers to borrow the limited available shares, or very limited supply, or both. It significantly increases the financial pressure on anyone holding a short position because they're bleeding money just to maintain their bet against the company. Why the stock is hard to borrow right now. Highlight CTB number. This brings us to why VRAX landed on our hard to borrow screener. VRAX Biolabs Group Limited currently has an annualized cost to borrow fee of an astonishing 849.0%. To put that into perspective, that's a massive amount to pay just to hold a short position for a year. What's even more striking is the CTB momentum. It has surged by 742 percentage points over just the last 5 trading days, indicating rapidly increasing demand or shrinking supply. Currently, there are only about 35,000 shares available to borrow. When you compare it to VRAX's estimated float of just 0.8 million shares, you can see why the supply side is incredibly constrained. Our internal composite squeeze score, which factors in CTB, momentum, borrow supply, float, and technicals, gives VRAX a score of 62.2 out of 100. It's important to note, though, that high cost to borrow doesn't guarantee a squeeze. It can also signal that short sellers have very strong conviction and are willing to pay these exorbitant fees because they believe the stock will drop significantly further. Also, today's volume for VRAX is 247,500 shares, which is only 0.16 its 30-day average volume of 2,686,490 shares. This low volume, combined with a tight float, can make the stock prone to sharp moves on relatively small buying pressure. Squeeze mechanics explained. Show animation of short squeeze. So, how does a short squeeze actually work, especially with a stock like VRAX? When a stock is hard to borrow due to limited available shares and high demand, the cost to borrow skyrockets. If the stock price starts to rise, short sellers face a double whammy. Their positions are losing money on paper, and they're paying a huge daily fee just to stay in the trade. This combination could force some short sellers to cover their positions. Covering means buying back shares in the open market to return them to the lender. When many short sellers are forced to buy back shares simultaneously, this sudden buying pressure can drive the stock price even higher, creating a snowball effect known as a short squeeze. It's a vicious cycle for shorts, as their buying further fuels the price increase. Dilution risk check. Show green check mark. A critical factor to consider with any potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can depress the stock price and effectively negate any short squeeze thesis, even with high cost to borrow fees, because the increased supply makes it easier for short sellers to find shares to borrow or cover with. In VRAX's case, we checked for recent dilutive SEC filings like -1s, -3s, or 424 BS within the last 90 days, and found no immediate red flags. This is a positive sign for the squeeze potential. Recent reverse split watch. Show timeline graphic. Now, something crucial to consider for VRAX Biolabs Group Limited is its recent reverse stock split. VRAX executed a 1-4-25 reverse split on June 26, 2024, which was just 18 days ago. A reverse split reduces the total number of outstanding shares and, in turn, often the tradable float, while proportionally increasing the share price. For example, if you own 25 shares at $1 each, after a 1-4-25 split, you'd own one share at $25. Historically, we've observed a pattern where many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market adjusts to the new share structure and reduced float. It's a pattern, not a guarantee, but it adds another layer of potential catalyst to VRAX's current setup. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show VRAX chart with key levels. So, what should you watch for with VRAX given all these factors? First, keep a close eye on the cost to borrow fee and its momentum. Any further increases would intensify the pressure on short sellers. Second, monitor the available shares to borrow. If that 35,000 number continues to shrink, it's another bullish signal for squeeze potential. Third, watch for any significant increases in trading volume, especially on green days, which could indicate buying pressure that might ignite a squeeze. Finally, remember that historical tendency for post-reverse split volatility. Given that VRAX's reverse split was only 18 days ago, it's still well within that observed window where microcaps sometimes see increased action. Call to action graphic. VRAX presents a fascinating case study in the world of hard-to-borrow stocks, combining extremely high cost to borrow, a tight float, and a recent reverse split that could still be playing out. While the setup is certainly intriguing, always remember to conduct your own thorough due diligence. This isn't financial advice, but rather an educational exploration of a stock with unique characteristics. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives into hard-to-borrow stocks, and let us know in the comments if you're tracking VRAX or any other interesting squeeze plays. We'll see you in the next video.